So now we're at Module 7, Liquidity and Partial Budgeting. This is going to be Chapter 7. We're not going to do the entire chapter, but so here's the page numbers, 187 to 198, and then 206 to 208 will be the sections we focus on. In addition to Chapter 7, we'll also be doing partial budgeting, and I'll show you how to do that. So building on the previous module, before Module 6 talked about wealth or your growth over time. And in order to have higher growth, you need to expand. So you need to become more profitable, more efficient, and sometimes that means getting better equipment, making new investments, expanding your operations, which also means making new investments. And so this really kind of builds on that, because this chapter is talking about the need for liquidity, and you need that liquidity for expansion, these new ideas, and carrying out and making those changes. You also need ways to evaluate those new ideas, and so one way is a partial budgeting, and so we're doing both in this module. So why do we need liquidity? You need it for 3 reasons: make transactions, as a precautionary measure, and to make investments. Transactions are your day-to-day business needs. So you need liquidity just to pay your bills on time. You know that you have bills coming due. You need liquidity, money flowing through to pay for those. Precautionary is what if. What if you end up having more expenses, you don't get the money that you think that you were going to get on something, whatever. Things come up, and so precautionary demand is your safety net. You have that money there available in case something happens. Investment demand is using money or liquidity to make new investments, buy new equipment, buy new land, buy machinery, whatever. It's an investment. So the sources of liquidity are either from your assets or your liabilities. The assets are, if you have liquid assets that are available, or the ability to turn those assets into cash, then we can use them as for liquidity, use them as cash to pay those bills, for precautionary other things. Liability liquidity comes from credit reserves, borrowing more money. So for asset liquidity, liquid assets are assets that are cash or available to be turned into cash. The degree of liquidity is the asset's sales value relative to its economic value. That sounds kind of weird, but when you think about it, an asset's economic value is kind of what it has as a value in use in your business, and the sales value is what you can get out of it. So if you think about inventory of wheat, really to be used in your business, it doesn't have a lot of value. It's not going to help your business grow or anything. But if you turn it into money, then you get that money out of there. It has a high sales value relative to its economic value. For something like a tractor that you need to plant and harvest and everything else, its economic value is valuable to your business. You won't be able to plant without that tractor, so it has value to your business. However, which is much higher than what you might be able to sell it for. So perfect liquidity is if the sale generates cash equal to or larger than the reduction in the value of the farm. Things that limit the asset's liquidity includes transaction costs, volume of trading. So like for land, if you don't, if not a lot of land is sold on a regular basis, then it's hard to establish what that value is. There's not a ready cash price there available. Tax obligations if you sell assets. Speed with which the sale must take place. If you've got time to sell, like your land, then it might be one value, but if you have to have that money tomorrow, and what you can get out of land if you have to sell it tomorrow might be a lot less. Liquidity risk is unanticipated variability of the asset's value over time. So for example, your wheat might have some liquidity risk because the market's going to move around. The less variable the market price, the greater the liquidity. So even things that have a ready cash market may still have some liquidity risk. Now the other side of liquidity, or the source, is liability, and this is unused borrowing capacity. This can be difficult to measure because really how much can you borrow? But sometimes you might have formal agreements like a line of credit that you set up in advance. The methods of doing this is increasing your borrowing, but also carrying over or extending loans, deferring payments on loans, refinancing. And so these bottom ones are really talking about what you can do, how you can use that liquidity during times of stress, or to make investments. The advantages of liability liquidity is that it doesn't disturb the firm's basic assets. So you're getting liquidity, you're getting access to funds that you can use for all those different reasons without affecting the firm's basic assets. We don't have to sell the tractor off in order to do this. There's no liquidation of those assets. Transactions costs are fairly low, and there's a high degree of flexibility. The disadvantages are when you use liabilities, you're borrowing money, so you're going to have to pay interest. There's a cost to doing that. You need to establish your credit, and so to be able to qualify for loans. There's also sometimes non-interest charges, fees, appraisals, etc. And in extreme cases, financial control may shift to the firm's lender. For example, they may have liens on some of your assets, so you can't just sell them whenever you want. They may actually have restrictions on when you can sell those, where you can sell those. The check might actually go to the lender instead of to yourself. The lender may have to sign the check in addition to you to be able to cash it. There's all sorts of things that may happen. The lender may also even put stipulations on what types of crops you can grow or other things. So that was the reasons for liquidity, the sources of liquidity. Another idea is credit concepts and borrowing behavior. In general, and this isn't something that you can just make a decision within your business, but I think it's a good thing to really kind of think about just conceptually. In general, you will pursue your most profitable enterprises first. So the returns from the first money that you borrow should be the highest, and less so as you expand. Because as you expand, you've done the most profitable things you can do first, so as you expand it may be slightly less profitable, diminishing marginal returns. On the other hand, the cost of borrowing will go up as you have more debt. You're more risky. You have less reserves. Banks are going to require higher risk premiums. And so at some point, the marginal value from borrowing is going to equal that marginal cost. One line's going down, the other line's going up. This is usually less than when you've used your total credit available. And so sometimes the most optimal decision isn't to have borrowed all the money you possibly can. Another thing to think about is lender-borrower relationships. It's good to have good relationships with more than one lender. It's very difficult to start a relationship with a new lender during financial stress. And sometimes you think that you really have a great relationship established, but I've talked to numerous people over the years, I've seen it with my parents, where sometimes the loan officer that they were using moves to another bank or another branch, and a new loan officer comes in with different personalities. There's personality conflicts. Maybe the bank's policy suddenly changes, and sometimes this can happen during your most difficult times. And during those times, that's the hardest. It's one thing for a lender to say, oh, we'd like to lend you more money when they're used to doing business with you. But to come in and say, well, this other lender doesn't want to work with me, now can you, when I'm not looking so good? So if you have relationships built up with more than one lender, sometimes they're able to, when one bank, like say one bank does your operating loan, another one does your mortgage, if you have run into difficulties with one, it may be that the other one will say, oh, and so we've done your mortgage, you're really good, let's go ahead and do your operating loan too. On the flip side of that, though, is sometimes lenders give you a better rate if you do all of your loans with one of them, or lower closing fees or something like that. So you've got to kind of balance out the two things. Here's another conceptual idea related to lending and borrowing. Lender preferences are that loans are self-liquidating. Self-liquidating loans mean whatever we borrow the money for is going to generate enough cash to be able to pay off that loan. For example, your operating loans where you're buying seed and fertilizer, and the value of the wheat that it's going to grow should be higher than the cost of the seed and fertilizer, so it's going to generate enough cash to pay itself off. It's self-liquidating. Asset generating, on the other hand, is where what we're using the funds for, we're buying an asset that has really good collateral. In case you default, there's going to be money there available to pay for the loan. For example, buying a tractor. And so lenders would love loans to be self-liquidating and asset generating. So that's the most preferred. However, if they can't be both, then at least if they're one or the other, and the loans that are bad are ones that don't generate enough funds to pay themselves off, and also there's no collateral there. And so this is the quadrant that they really don't like. A lot of operating loans are probably self-liquidating, but they don't have assets generating. Machinery and equipment purchases a lot of times will be intermediate. They're asset generating, but they may not be self-liquidating. So we've kind of talked a little bit about just conceptually what the liquidity, why we need it to make the new investments, to analyze things, funding issues with lender relationships and other stuff. And now here's going to give you, we're switching gears a little bit, and partial budgeting is a tool to help you evaluate those new ideas. Should I pursue them? Should I pursue obtaining credit for them or just making the changes? We're going to get into more sophisticated ways of evaluating new ideas in modules 9 through 13, where we look at multiple years. Partial budgeting, what we're looking at here, is for a single year, and it's kind of a back of the envelope type method, but it's a really good place to just start and get a feel for what's going on. And then sometimes if the idea looks good at this stage, we may go into some more sophisticated methods. So it's partial because it only considers what would change rather than all the costs and returns. It's for a single year and evaluates the overall net return from changing something. So we're looking at making a change. Is it good or bad? It compares positive amounts, which is additional revenue and reduced cost, with negative amounts, which is reduced revenue and additional cost. And let's go ahead and just look at one here.